Hello, welcome to the latest edition of the Sky Accountants podcast. I'm Ashley Carmichael and I'm here today with Anthony Cortese. Anthony's a client manager here with Sky Accountants. Welcome, Anthony.
Thanks, Ash.
Thanks for joining us today. And, we're going to be having a bit of a chat about super today, what we might call the ever-evolving landscape of super. As many people would no doubt be aware, there's been quite a lot of change over recent years in the super space, and there's actually quite a lot to be across, and some of these changes are reasonably straightforward, insignificant, whereas some of the others are really significant or transformational. So we did put out a blog on this fairly recently, and we thought it would be good value to have a bit of a catch up and dive into some of these changes that have either happened or are happening, to make sure that everyone out there is across what's going on. So let's dive in, shall we? So the first thing is fairly current, and it is the amendments to the National Employment Standards to enshrine the right to superannuation in the NES with effect from the 1st of January 24. So effectively what this means is that employees can take action, legal action against employers under the Fair Work Act to recover unpaid or underpaid super. It doesn't replace the super guarantee system that we will all be aware of that's administered by the ATO. It merely supplements it. What's your take on it, Anthony? Do you think this is a significant concern for employers, or
Yeah, look, I think the obligation, it's still going to be policed by the ATO. Don't expect to see a great volume of cases where employers are taking direct action with their employers. It's more likely still to be managed by the ATO at that level. We just need to be aware, or more aware, that paying employee super contribution is a significant matter of concern to the government, and they're tightening the net with things that they're putting in place.
Yeah, look, that's got to be a bit of a common theme in what we're discussing today, but certainly does look like that. I know I personally won't be laying awake worrying about this one. I think it's going to come up in fairly extreme circumstances, and really, the ATO is expected to deal with payment of super contributions in the vast majority of cases. So unlikely to come up often, but as you said, something that employers need to be aware of, and just reinforces this idea that it's important to be across this, across the super contribution requirements. There is one aspect of it that does have a bit more of a practical application, which is the Fair Work Information Statement, which hopefully our listeners are aware that when somebody new begins employment, employers need to provide them with the Fair Work Information Statement. That statement's been updated to reflect this change, so it's available on the Fair Work Ombudsman website. Go and get a copy, make sure you're giving out the right version. All right, next cab on the rank, Payday Super. This is a big one. And so there was a media release in May 2023, if memory serves, the Honourable Treasurer Jim Chalmers and Mr. Albanese, our Prime Minister, announced that we will be having a Payday Super system from the 1st of July 2026. So a little way off, but why is this so significant, Anthony? Like, can you give us a bit of a contrast of what we're doing now versus what they've got in mind?
Yeah, sure. Look, the most significant factor here is the cash flow implications for businesses. We're going to be going from quarterly, for most businesses, quarterly contributions to paying super when you pay your employees, whether that be weekly, fortnightly, or monthly. So that's going to have a huge impact on businesses in controlling their cash flow.
Yeah, and look, as that date gets a bit closer, I think there's going to need to be a fair bit of planning involved around the cash flow crunch that might arise from the transition into that new system. You know, as you said, under the super guarantee law, the minimum standards paying contributions once a quarter.
Yep.
I know some businesses voluntarily pay more regularly, like monthly, but you know, we're potentially dealing with you know, this sort of crunch of paying contributions or finishing up paying contributions in the old rhythm, and then having to also get into the new rhythm of Payday Super at the same time.
Yep.
It's all a bit up in the air though, isn't it? Like, you know, I think it's pretty likely that they're going forward with it, and we know that they've done some consultation in calendar year 2023, but we're really yet to see much in the way of what the system design is going to look like. Any insights on when we might see something, Anthony?
Oh, hopefully we will hear something more in the upcoming May budget, 24-25 budget, federal budget. And we'll hear a lot more about it then, and hopefully get a bit more detail.
Yeah, look, I think there's probably a fair bit of water to go under the bridge on this one, and we'll obviously be keeping our listeners updated. But yes, hopefully, you know, there's been some speculation that we'll find out a bit more in the budget this year. So hopefully that's the case.
Yep.
All right, super guarantee compliance. November last year, ATO put out their statistics, as they periodically do, around SG compliance. And I think they reflect reasonably favourably. You know, they seem to be suggesting that around 94% of employers are paying the correct amount of super on time and doing the right thing. However, there is a number that's reasonably mind-boggling, at least to me, which is what they call the super gap. So you know, we might have heard of tax gaps and that sort of thing before. This is where the government or the ATO perform some calculations to try and work out, well, what's gone missing, so that, you know, the contributions that should have been paid that didn't get. And they've sized that at around about $3.6 billion, which is a not insignificant number, is it?
That's a decent number.
And so I guess this sort of harks back to comments made a bit earlier in the piece about the government being really concerned about this. And, you know, we know that the ATO is being equipped with more and more power and incentive to try and shrink that super gap. What's the latest on that front, Anthony?
Well, And with the advent of the single touch payroll and super stream, which is now well entrenched in the SG compliance landscape, the net is closing on those non-compliant employers. The ATO is able to use the data from these systems to pretty much weed out those employers who are behind or have unpaid super obligations.
Mm. Yeah, look, I've been around a while, and I know you have too. And the level of transparency that the ATO have these days around what employers are doing, both in terms of contributions that are accruing and contributions being paid, like it's really unprecedented. They have a very clear picture nowadays, don't they?
Yeah, I sure do.
And look, anecdotally, we often see the letters come across our desk on behalf of clients where the ATO are looking at whether or not contributions are getting paid on time. So,
yeah,
anecdotally, I'm seeing an increase in that sort of activity, and I think, sort of more broadly, they are focusing both on education and on compliance. All right, more super guarantee. I feel like a broken record saying that. But we've also got a upcoming change in the super guarantee rate. So this is the minimum amount of super that employers are required to pay. We're currently at 11%. We're working our way towards 12%, which is where it will stop. And next step on the path is 11.5% from the 1st of July. Any comments around what employers should be doing in prep for that new rate coming in, Anthony?
Yeah, look, they need to make sure that from the 1st of July that they're paying the correct rate, which is the 11.5%. And making sure that their payroll systems are all updated to reflect that. They'll also need to look at their salary packages and make any adjustments when necessary to the salary packages. We find that there's a lot of some salary packages which are inclusive of GST as opposed to exclusive.
Sorry, the slip of the tongue there. You said GST. I'm sure you meant SGC, but
sorry, SGC.
But look, they're not uncommon, are they? Where we see, they're probably not the most common, but they're certainly not uncommon to see those salary packages where it's on a super inclusive basis.
Yeah.
Which presents a bit of a conundrum, doesn't it? Like, in theory, the employer should just simply reweight it to reflect the new rate. So the salary component goes down a little bit and the super component goes up. It's not that simple though in practice, is it? Well, I don't know about you, Anthony, but I've certainly seen some angst where employers look at doing that. So I look at, my comment on that is if you do have employees on super inclusive packages, and you are intending to follow those to the letter, important to get the communication out to the employees and help them understand what's going to happen well ahead of time, because if someone perceives it to be a pay cut, it's really not great for workplace morale, is it?
No, it's not.
All right, not far to go. Next one we wanted to touch on is around stapled super funds. Somewhat new, but really that, these have been around for a while now, but what we do find is that awareness of this is not necessarily great. And so what this is all about is when you're onboarding new staff. And hopefully employers are all aware that one of the things we need to do is give the new starters a choice of super fund form to fill in. And as has always been the case with that, there's essentially three things that might happen. So the first thing is that the employee might just do nothing. They may choose not to fill in the form and give it back to us. Or they may fill in the form and they might tick the box that says, I want to go into my employer's default choice fund. Or the third thing they can do is they can nominate the details of their preferred fund. Now, if they choose their own fund, it's business as usual. We, set that up and their contributions go in there. That's all fine. But if they either don't give us the form or they choose the default fund, we have this new step. We don't just go to the default fund. We have this new step of checking whether or not they have a stapled super fund. And a stapled super fund is essentially just a fund that is connected to that employee and essentially follows them around from job to job. And idea being that people don't just keep accumulating fund after fund after fund with small balances in them. And so there is a method of checking the stapled super fund with the ATO, and if you find that there is one, then that's the fund that we have to use. If there is no stapled super fund, then we go to the default fund. And so, as I mentioned, I've certainly found that awareness of this is not great. How have you found it, Anthony?
Yeah, look, it's not something that's well known amongst employers out there, but it's something that they need to be aware of. It's an obligation that they need to comply with.
But look, haven't been aware of any sort of compliance activity around this yet. It is still a fairly young system, and at some point there will be a bit of a tightening up there, and if employers are not following the right processes, they might find themselves in a bit of strife. All right, well, that sort of is bringing us towards the end of the podcast today. But before we sign off, Anthony, is there anything else happening out there in the world of super that's relevant that people should be aware of?
There's always things, as you know, Ashen, happening in super. One of those things is around the annual super contribution caps. Currently, the concessional cap is at 27,500, and that cap's used for employer contributions or personal tax deductible contributions. And then you've also got the non-concessional cap, which is currently at 110,000, which is essentially for personal undeducted contributions. These are usually indexed in line with weekly average time earnings. The AWO data published recently is suggesting to us that indexation is going to happen shortly. We'd expect, if we did see an increase, that the concessional cap would go up to about $30,000, and the non-concessional will go up to 120,000. Now, this isn't confirmed, but it's very likely to happen at some stage in the near future.
Yeah, that's right. There's, if anyone reads sort of the financial news and that sort of stuff, there's been a lot of talk about the indexation up to 30K for the concessional, and of course the 120. So yeah, from what I'm seeing, it's looking quite likely like that it will happen. But you know, as we always suggest with these things, let's not get carried away until it's confirmed.
Yep.
You know, creates a bit of an opportunity there for those who are trying to maximise salary packaging and or super contributions, doesn't it?
It sure does.
And you know, you made a comment earlier, I believe, about employers needing to keep an eye on how they've structured salary packaging arrangements when we're talking about the SG rate increasing, and this is going to be in that same boat, isn't it?
Yeah, it sure is. Yeah, they need to look closely at it and how they structure it. But it could be some implications to it.
But all right, well, good to know. Good to know. So thanks for joining me today, and hopefully we've covered off some of the more significant changes happening in the super space. And if anyone does have questions around super, encourage them to get in touch. Thanks for joining me, Anthony.
No worries. Thanks, Ash.
Thanks. See you next time.